right, so let's begin. The Insurance Regulator and Development Authority of India, IRDAI, has once again come ahead for the protection of policyholders. And this time, IRDAI has proposed changes to the existing format of the Customer Information Sheet, which is CIS, that insurers have to provide with policy documents at the time of purchase and renewal. At present, insurance companies follow the template set in 2020 when CIS was introduced as a part of guidelines on product filing in the health insurance business. Let's understand all of this and more in detail with Anuj Parekh, co-founder and CEO, Healthy Sure. Anuj, good evening and welcome to the show. So what exactly are we talking about over here? We know that IRDAI is very active in protecting all the interest or best interest of policyholders. But then the fact that there is some new addition or a new format of CIS, let's just break this down with understanding what exactly is CIS and how a policyholder needs to understand the importance of this.
Yeah. So thanks, Kavita, for having me here on the show, and I hope that I could add to the knowledge of all the viewers who've been closely following this update. So, customer information sheet was, you could say, an initiative that IRDA had launched in 2020, which would allow retail insurance policy holders to clearly understand the policy benefits that they have subscribed for. That was, I would say, at a very holistic level where at least the policy benefits of what's covered and what's not covered, with certain parameters around the waiting periods was mentioned. But yes, IRDA has now announced a new format, which is more objective in nature, which will allow policyholders to clearly understand that what are the key parameters of the policy. Something as simple as sum insured is what policyholders at times don't clearly understand because there is also no claim bonus and there is accretion of the sum insured over the years. So people don't really understand that what is the current sum insured that they are holding. So sum insured to start with the type of policy, say for example whether it's a lump sum based cover or a indemnity based cover. So lump sum based cover would mean that on diagnosis of an incident, you get a straight flat sum insured to the policy holder. But when it comes to an indemnity based cover, that means a traditional hospitalization cover where to the tune of your actual expenses you are compensated. So even fine distinctions that like these need to be clearly called out for policy holders. And the idea is that the policy holders should actually now even sign up for these benefit or parameters at time of purchase of policy. So one big change that's happening under this customer information sheet is that the policy holder signature is required before the payment of the policy. So this is one big change which the insurers will have to build into their user journey as they sell the next batch of retail insurance policies, so that they have the policy holders consent on the benefits, and this will avoid any form of mis-selling that would traditionally happen in the space. So this is a step in the right direction. And yes, insurers and the distribution intermediaries would figure a way out together as to how do they continue to simplify the journey of purchase, and that would help the policy holders make more informed decisions.
Right. So, Anuj, that's the last line that you just said. I think that's the most complicated and the most unpredictable ones, the intermediaries. Health insurance as a product, if you see, traditionally or even fundamentally, is not supposed to be a complicated product, okay? And now, as compared to life insurance, we see less mis-selling cases in health insurance. We just see a lot of claim rejections and, the insurance companies not giving you the coverage enough and all that stuff. But then when we talk about health insurance and we talk about giving the kind of right information and also the grievance redressal, which I think is in a better way initiated now with this current addition or change. I really want to understand how do you think would this be impacting the overall decision making of a policy holder? Also, from when do you see this implementing by insurers? And as far as me buying an a health insurance policy from an insurance company, will that impact that, or is just a procedural change which gets more transparency and maybe gives more power to a policy holder? If that is the case, you can explain.
Yeah, so life insurance, as you rightly explained, so here we have something called as benefits illustration. This is what a user signs up for. That what is the per annum premium that they are going to pay? What is the sum insured that he or sum assured that he would get on retirement or on death, depending on the type of policy, and what would be the rate of you could say returns onto that policy if it's an investment linked product. So he clearly understands the benefits that he signs up for. Health insurance is possibly slightly more complicated than life insurance, and this will help the user's understanding of what his benefits are. Because today, when you talk about health insurance selling, today you will have different set of documents. One is the policy brochure, the policy prospectus, the policy wordings, and the customer information sheet. So the policy prospectus and the brochure are more or like marketing collaterals. So you may not understand what is the clear fine print of the policy until you read the policy wordings. So customer information sheet is an objective information around the policy prospectus and brochures combined. So the customer, while he can see the brochure to understand, okay, what are the key benefits that matter, but at least no benefit goes unnoticed. If there are any fine print benefits like sublimits on what is the room rent, or what is the waiting period, or what is the specific exclusions on the policy, even something like what's the claim settlement process has to be clearly defined under the new format of the customer information sheet, and even the port out process, which we term it as migration, even that process needs to be clearly called out. And the most important change, as I mentioned, is that the customer has to consent to signing on these benefits, which earlier was not the case. So earlier, while insurers will issue a customer information sheet, quite likely that the customer will not have even seen it. So now it's mandatory for them to sign up for those benefits.
Anuj, so very good thing now the entire CIS is standardized, okay? So there is no confusion because all the insurers had their own format of
Yeah.
CIS. But then talking about the additional features, apart from the stuff that we just focused and we spoke about, I really want you to stress on the grievance redressal. Now this
Hmm.
document specifically talks about grievance redressal, and it is an existing feature also, but what's new and what's the kind of thrust that's been introduced in the CIS or in a standardized form of CIS?
Sure. So I would still need to understand into more detail of what has really changed in that customer information sheet when it comes to grievance redressal. But what I understand is that so far the grievance redressal process was not forming part of the customer information sheet. You would only get the details of the IRDA ombudsman process, but each insurer has to have an in-house grievance redressal officer, and there has to be a grievance redressal mechanism. So, to the best of my understanding, the current new format of the customer information sheet will carry the contact details of such grievance redressal officers, and they can be contacted to in case of grievances, and only in the last stage should you resort to an IRDA ombudsman process. So I don't think there's been, except for sharing the contact details of those grievance redressal officers, there's no other change that has happened in the customer information sheet. But at least people have the awareness of who do they approach in case of any claim rejections or under settlement of claims.
Okay, Anuj, one case of claim rejection you think could also, I don't know the current rate or the status of claim rejection. Maybe you could give me some kind of a ratio or maybe a number in terms of percentage. But
Hmm.
the fact that the changes in the CIS includes migration to different policies and inclusions and exclusions kind of information also, which are in a way included in your policy document also, but CIS gives specific focus on this. So when we talk about claim rejections, the kind of information that a policy holder will have to give and be really honest, which they anyways should be when buying or getting into a contract like a health insurance, you think rejection might just go up?
No, so this customer information sheet will not carry any form of health declaration of the user or the insured policy holder. It will only specify what's the waiting period and what are the key exclusions. Many a times it so happens that a user has gotten hospitalized, but it is not for a valid reason. It is more on a preventive or precautionary measure, and that is one of the reasons of claim rejection, that you need to get hospitalized. Then there has to be a valid reason for getting hospitalized, and it cannot be in preventive in scope. Otherwise, you can access OPD hospitalization or OPD curative treatments, which is not the scope of most of the health insurance plans that we have today. Second big reason for you could say claim rejections is, as you rightly pointed out, customers don't clearly declare their pre-existing health conditions. So that problem will not get fully solved with this new format of CIS, because that doesn't capture the user's pre-existing health conditions. But yes, the policy copy will cover for those health declarations, but this will at least call out explicitly that to what extent or to what period is those waiting periods applicable on the pre-existing health condition. So the user will not be caught off guard, say that he's declared his health conditions, but he was unaware that there was a waiting period under the policy. So that will get clearly called out. So there will be larger set of awareness, but will not completely address the problem of claim rejection, because that's more of an understanding of whether that hospitalization was A, whether valid or invalid, and B, whether you had correctly disclosed your health conditions at time of signing up.
Anuj, this is just a proposal for the changes in the format, or
Yeah.
this has already been implemented?
No, this is just a draft proposal or format
Sure.
that has been prescribed by IRDA, and they have invited suggestions from the industry. So this has not yet formally been announced for insurers to start adopting.
All right, so these are the changes which are proposed in the new CIS format, which is very important for a policyholder to understand, because the kind of information that insurers need to gather will be a standardized format of information which has been proposed by IRDAI, although the implementation of this is still pending. Thank you so much, Anuj Parekh, for being on the show and helping our viewers
Yeah,
understand this new
thanks
change.
so much.
Thank
It
you.
was my pleasure.
Thank you. All right, so on that note, it's time for a quick break. But then post that, let's talk about large cap funds. Now, looking at the broad-based market rally, would we see revival in active large cap funds investment? The valuations are very comfortable right now. How can you look at active large cap fund investment as compared to a passive strategy now? More on this after this break. Welcome back. You're watching The Money Show with me, Kavita Thapliyal. So what's in store for large cap funds? With most investors turning towards passive large caps, to active large cap funds would gather investors' trust, and with the broad-based rally in the market and valuations being comfortable, large cap funds will gain momentum. Let's answer all of these questions. I have with me Nirav Karkera, Head of Research, Fisdom. Nirav, good evening and welcome to the show. So definitely investing in large cap is gaining momentum via the passive strategy, or the passive investment options. I want you to help our viewers about the kind of broad-based rally that we've seen in large cap and the kind of impact we might see on large cap funds going ahead. How true it is, the momentum that we are talking about, and also the kind of valuations that we are seeing in large cap, a huge run-up already seen in mid-cap and small-cap, that's where the fear has slightly come into the investors, that would this kind of profit or earning would remain or would continue, would sustain. But then large-cap is a very interesting zone right now, specifically active large-cap. What's your view on it, and what does your research say?
So I'll, probably take the second question first because that's far more simpler to answer. So when we talk about valuations in the large cap space, it is clearly not cheap right now. I would say that. However, considering the context around small caps and mid caps, it is relatively more favorable in large caps at this point in time. And in fact, if you look at the earnings growth trajectory and you pencil in all the expectations and forecasts, growth forecasts, one tends to form a picture that large caps are available at slightly reasonable to slightly costly sort of valuations at this moment in time. However, most opportunities that are available in the large cap space now is available at a fairly decent valuation, especially in context of the growth that we are expecting. And so on the valuation side, I feel large caps are favorably positioned at this point in time, and more so when compared with small and mid cap counterparts. Secondly, if we were to talk about the value proposition offered by active large cap funds, so it is about time that actively managed large cap funds got us due credits, because for the longest period in time now, it seems like a really long time that actively managed large cap funds are compared with large cap indices, and they have been underperforming since quite a few years, except for this very recent year. So over the past year or so, actively managed large cap funds have been performing, and most of it, as you rightly mentioned, is attributable to the broad based rally. So what happened before this year is that there was a narrow rally. There was a lot of liquidity in the market. There was a lot of influx of inflows, especially from foreign investors, and all of these inflows were collectively getting accumulated in very select pockets in a very narrow, and resulting in a very narrow rally within the index. And these select pockets are, as you can already see how it reflected in the indices, were heavyweights on the indices. However, that is changing right now. So the money, the capital inflow is now spreading out across the market, not just limited to large cap, but it is reaching to the deeper and farther ends of the market. So the rally that we are seeing right now is much more broad based, and this is offering fund managers an opportunity to capitalize upon their skill sets of sector allocations and stock picking. So right now, the effect is seen in the form of large cap, actively managed large cap funds outperforming indices, and the cause is active fund management and impeccable stock picking and sectoral allocation strategies that are finally bearing fruit.
So, also considering a case where there is exposure, or the kind of funds where there is exposure of large cap, talking about flexi caps, which are more dominated, which we have a lot of flexi cap funds where they are large cap heavy. What about the change in story over there, or change in movement or momentum over there in those kind of funds?
So, flexi cap funds still continue to remain large cap oriented, and the major reason could probably, while talking about it, we could probably circle back to the very initial set of conversation that we had on today's episode. That is, the valuations are looking far more favorable, like especially in context of the growth opportunity that is available within the large cap universe. So the flexi cap mix remains largely within similar ranges. It still remains skewed towards large caps. Obviously, there are a few cases within the flexi cap category wherein one could notice an increase in mid and small cap allocations, but we believe that it is transitory, and it has to do with the run up in value of small and mid cap holdings more than new mid and small cap holdings added to the portfolio in most such cases. So there remains an orientation, a bias towards large cap and slightly larger mid caps, if one were to look at it from a much more nuanced perspective.
Nirav, what kind of sectors and stocks in large cap are mutual funds going heavy or aggressive?
So one thing you'll realize when we spoke about active share increasing within large cap funds, and smart sectoral allocation is something that I spoke about, you'll realize that many large cap funds are not shying away from taking sectoral calls and being slightly aggressive with the allocations therein. So one case in point is IT. So while IT claims a very heavy share, approximately 13 to 14 odd percent on the indices, the category itself is meaningfully underweight by almost 4 percentage points, right? So that's where there is a sectoral allocation that has come into play. On the pharma side of the sector, the category has been allocating tactically to select names, and it is slightly more overweight there. I feel the category is, has been really aggressive on allocating to capital goods and industrials as broader sectors, and this has also been bearing fruit in terms of incremental performance for all such funds. So these are a few sectors where large cap funds are trying and taking very nuanced call, and such nuanced call does not always have to be overweight calls, but it also includes cases where underweight really helps. Like case in point IT, wherein they were underweight, and IT, we all know since the past couple of quarters has been under a lot of pressure. So large caps have been able to successfully navigate this rough patch by being underweight on this sector, at least till now.
So now, considering this analysis that you've just shared with us, Nirav, what are the large cap funds that you are recommending? And also, is it really time to consider active large cap funds?
So again, I'll take the second question first. I feel
Okay.
it is indeed so, because that's the simpler one, right? So it is indeed time to consider actively managed large cap funds. So active versus passive was never really the true debate. It is about allocation and what are you expecting. It is not really comparable. Both of these categories, active and passive, are managed through different mandates and different set of rules. अगर आप एक अलग नजरिए से देखते हो, if you view it from a different lens, you'll realize that many active funds also behave like passive because they stick to their set of rules. And passive indices in a way is actively managed because they frequently rebalance to align with their primary rules. I know obviously it may sound counterintuitive, but we'll leave it for some other conversation where I'll double click on this concept. But one must understand that actively managed large cap funds do present a very strong value proposition. And if the objective is to generate alpha, there are going to be opportunities in India. Structurally, fundamentally, actively managed large cap funds warrant an allocation. There could be patches wherein the index could outperform it, but that's like with any other category, right? There could be another category where the index could outperform it for a certain period. It's just that we haven't seen it happen as often as we saw in the large cap. So yes, there is definitely scope for allocation to actively managed large cap funds, and it's not just seasonal. Is what I'm trying to impress upon the viewers. Second, let's talk about the large cap funds that we are particularly looking at really closely. So at Fisdom, we have our own mutual fund rating methodology, and as per those Fisdom mutual fund rating methodology, we have realized that there are a few large cap funds that hold immense promise in terms of delivering value to investors. And at the top of the list, I would say there are two funds. One is Mirai Asset Large Cap Fund and Canara Robeco Blue Chip Fund. These two are outstanding funds for investors looking for a true to label mandate. Funds where they are going to stick to the large cap mandate in its truest essence and spirit. I feel these two funds are really fantastic. There are another two funds which tend to go slightly rise beyond what is expected from them. They step up to the occasion. They want to manage it more aggressively for the investors who have an appetite for slightly more aggressive and nuanced calls, and that would include Nippon Large Cap Fund and ICICI Prudential Blue Chip Fund. Now, the thing with these two funds are they are very nimble with their allocations, and they tend to deviate. They are not really trying to hug the index, while the others are also not. They are consciously making an attempt to deviate and take bets beyond what the index is indicating, and they utilize the residual 20%. So a large cap fund is mandated to invest minimum 80% into large cap stocks, and they have a 20% buffer zone. So this 20% makes a whole world of difference when I talk about these two funds here, where they have been really smart about the 20% allocation, and they deviate beyond large cap. They don't shy away from entering the mid cap zone and create and deliver value to investors. There is obviously always the argument that when an investor invests in a large cap, it is really looking out only the investor is only looking out for value that can be created through large cap alone. So an allocation, an investor can always manage allocation at his end. But for those who don't mind an extra kicker, these two funds are really well positioned. So four funds in all: Mirai Asset Large Cap Fund, Canara Robeco Blue Chip Fund, ICICI Prudential Blue Chip Fund, and Nippon Large Cap.
All right, so with these funds, it's a comeback for large cap funds. Thank you so much, Nirav, for being on the show and helping our viewers understand the way ahead for large cap active strategy. All right, we move on, and the deadline for exchanging the 2000 rupee notes is nearing. But key thing to note is that banks will be closed for 16 days in September for national and regional holidays. My colleague Snehi takes you through the process and RBI norms to be kept in mind while exchanging your notes.
That's right. Now we're already in the month of September, and if you still haven't exchanged your 2000 rupee currency notes yet, here's why you should rush to your nearest bank and do so at the earliest. Now before that, remember that in the month of May, the RBI had issued a notification which said that the last day to do so is the 30th of September, which is the end of this month. Also remember, the RBI had added that the notes will continue to be legal tender even after the deadline, but despite that, you should rush to your nearest banks and get the notes exchanged as soon as possible, because the deadline is just at the end of this month, but also because the banks are going to be closed for 16 days in the month of September. That's right, there are 16 bank holidays in the month of September. Now these holidays include Janmashtami, Ganesh Chaturthi, Eid Milad among others. Now while some of these holidays will see banks getting closed at a national level, some holidays will also see bank closures at regional levels as well. Now the process to get your 2000 rupee notes exchanged is pretty easy. All you need to do is walk to your nearest authorized bank, fill in a requisition slip, fill in all your details and get the 2000 rupee currency notes exchanged for other denominations. Now there are two things that you need to remember. First is, you do not need to be an account holder of the bank where you're going to get your notes exchanged. You can simply walk up to any bank and get your notes exchanged. And the second is, the process of exchanging your 2000 rupee currency notes is absolutely free of cost. Now, the RBI has set a maximum of 20,000 rupees, which is 10 2000 rupee currency notes to be exchanged at once. However, there is no limit on the number of notes that one can deposit into their account for withdrawal at a later date. So this is why you should rush to banks immediately and get your 2000 rupee currency notes exchanged at the earliest.
All right, with that, let's take a quick break, but then post that, I'll be joined by Kirtan Shah, who will be answering your financial portfolio queries. And before I slip into a break, I'm going to leave you with our number and our email ID also. This is a WhatsApp number where you can send us your queries, and our email ID where be it mutual fund, insurance, credit card, loan, crypto, anything and everything related to your financial plan or your financial portfolio. We have all the solutions through our experts to send us your queries. See you after this break. Welcome back. You're watching The Money Show with me, Kavita Thapliyal, and that part of the show where our viewers get connected and participate in the show. There are plethora of funds available in the market to invest your hard-earned money in, but how do you assess which is the right fund for your portfolio? What are the criteria that one should look at to help you navigate through this maze? We have on board today Kirtan Shah, founder CEO, Grievance Wealth Advisors. Also, do not forget to send us your portfolio queries on our WhatsApp number, which is 865-797-4571, or you can also email us your queries on themoneyshow@etnow.tv. So that's a line. Let's move on. Kirtan, good evening and welcome to the show. And we also have our first viewer, Mr. VP Singh from Dehradun. Hi, good evening, Mr. Singh. How are you doing today?
I'm well, thank you.
Thank you so much for sending us your question. And I believe you've been investing in a large cap fund, that is Axis Large Cap, since 2017. Is that right?
Oh, yes, that's right.
Any specific reason? Because you've been investing, the corpus that you've mentioned is around 15 lakhs and return is almost 11.5%. So why do you think you want to redeem the funds and invest somewhere else? Are you not happy with the performance?
No, my query from you is that I started investing in 2017, almost about 5 years, and now my corpus is fairly large, say about 17 lakhs, giving me a return of 11.5 CAGR. So since this Axis Blue Chip Fund is not doing so well, do I need to redeem, invest somewhere else, or should I continue? This is my question.
Okay. What other funds do you have in your portfolio?
I have Mirai Asset Emerging Blue Chip, this Axis Blue Chip, ICICI Blue Chip, Canara Robeco Equity Hybrid, Edelweiss Balanced, and Nippon Banking and PSU Fund. Also, I have, say now, whereas earlier used to be HSBC Money Market Fund. These are the funds with me.
Any specific reason you've been invested heavily in large caps?
Yeah, I retired. I'm a retired guy, so I thought I'll take less risk and say more safety. That is the reason.
Okay, and that you think you get a lot in large cap funds. All right, your other question is you're also investing in Axis long-term equity and the corpus over there is 5.5 lakh. Even that you want to understand if that should be redeemed and invested somewhere else, right?
That's right.
Okay, so since you just mentioned that you're a retiree, the kind of investment you're doing in these funds, this is for the time horizon for 4 to 5 years more?
Yes, 4 to 5 years more. Yeah, I can.
Okay.
Yeah, I mean, I'm 63. So yeah.
Okay. Okay. Any specific corpus in mind that you want to accumulate?
This is just wealth generation. Some expenditures coming up. I've catered for that with FDs. There's no issue. I just wealth generation. That's all.
This is just wealth creation. Okay. Any risk profiling that you want us to know about you or of you? Are you an aggressive risk taker or you are slightly somewhere in between?
I'm in between. Yeah, I've got it done with
Okay.
through somebody.
Sure.
So I'm a
Okay.
medium
Okay.
risk guy.
Sure. Okay. So that gives us a lot of clarity. Thank you so much. Request you to please stay online. Okay, Kirtan. So I think a lot of details were not there, but then I think you've got a complete picture of the portfolio, mutual fund portfolio that Mr. Singh has. Heavily invested in large cap. This one question I think you want, I would request you to address first because a lot of investors do this. They cannot take much risk and the only strategy that comes to their mind or a lot of time that's been recommended to them is also a complete out and out large cap strategy. By investing only in large caps, do you really mitigate risk? Or by diversifying, you actually mitigate risk, diversifying across market caps?
I think, Kavita, thanks so much for having me on the show first. Kavita, I think that's a very important question that's been playing on everybody's mind since 2018. Because in 2018, when the market regulator came out with categorization of mutual funds, a lot of things changed. Originally, before 2018, when you invested in a large cap fund, the fund was largely large cap, but there was still a flexibility to move some investments in categories lower than the large cap because there are multiple reasons why you don't want to put all your 100% money in a large cap. And in that context, if you see since 2018, large cap funds have faced it extremely difficult to be able to even beat the index, right? Now, if you look at Mr. Singh's question, an 11.5% return on a large cap is not bad. I would seriously believe that if you're investing in large cap, your fair expectation has to be somewhere around 11 to 12%. But while we talk about large cap, I think I would really want to play the large cap space using the flexi cap category. Because for me, if you look at flexi cap category today, it is very similar in terms of investing to how large cap mutual funds were investing before 2018. So largely, though flexi cap theoretically gives the fund manager the flexibility to invest between large, mid, small, if you look at the market dynamics, largely most of these flexi cap funds are 70-75% in large cap, making flexi cap as a category pseudo large cap category. Still giving the fund manager the flexibility to move between even mid cap and small cap to a small exposure, depending on what they envisage as valuation premiums between large cap, mid cap, small cap. So long story short, the way I look at it is if you really want to invest in large cap as a space, use flexi cap as a category to invest in the large cap space. Because I think still you will have 75-80% exposure to large cap, which with some flexibility with the fund manager, whether if they don't see real value in the large cap space or they see a lot of value in the mid and the small cap space, they have the flexibility to move here and there, but still the larger focus is large cap. Kavita, I hope that answers the question.
Sure. No, that really makes sense because most of these large cap funds are, flexi cap funds are large cap dominated and they are heavy there. It also, as rightly explained by you, the proper kind of diversification that's there. But also now to answer Mr. Singh's question, he is a moderate risk taker. He already has so many large caps in his portfolio. He also has a hybrid fund and also a debt fund. How do you think he should be changing? Also, even the ELSS category fund that he has. What exits would you recommend?
So, Mr. Singh, now that I have more details about your portfolio and thanks for sharing that, I would like to highlight that, Axis as an AMC is going through a lot of changes, right? Over the last 12, 18 months, there have been a lot of things that have happened within the AMC and structurally, a lot of things have really changed in Axis's equity fund management. A lot of fund managers, their equity head actually moved on and a completely new team has taken over. And keeping that as context, plus that you already have so much of exposure to other large cap schemes already, I would really suggest that you move out of the Axis large cap fund and diversify that money in your existing large cap schemes. Please understand, I'm not telling you this because 11.5% returns for me is not a bad return when you talk about large cap as a space, but because you already have a lot of exposure to large cap in other schemes and there is a lot of strategic change happening in the fund management team at Axis, which in my opinion will take some time to fructify, and for us also as market participants to understand how is it really bringing and adding value, because when you see so many changes happening in the fund management team, the fund performance that you've seen in the past largely starts becoming immaterial. So that's my suggestion, and keeping the same context in mind, if you have some other ELSS schemes that you've invested in, you can get out of the Axis scheme and move your money in those other ELSS funds that you have. If not, look at diversifying this into some other ELSS schemes, Mr. Singh.
All right. So, how should he be consolidating his portfolio now? Okay. So, one thing for sure that he needs to stop investing, right? I don't know. Mr. Singh, is the investment route via SIP or lump sum?
In between some lump sums also, as I mentioned.
Okay, okay. So that needs to be stopped in the funds recommended by Kirtan. Now, Kirtan, any new additions that he should be doing or maybe increase the allocation amount?
See, I think Mirai Emerging is a good fund, but I don't think beyond a certain limit they are taking more lump sum. But I think he did mention that he had a Canara Flexi. I think he can move the funds there. And if he's looking at another, probably a large cap and a mid cap name,
Hybrid fund.
yeah, then he can move to a Kotak India Opportunity Fund.
So, yeah, Kirtan hybrid fund he has, Canara Robeco. Is that
No,
what you...
No, I would not suggest him to move to an hybrid fund. In that case, he should look at a Kotak India Equity Opportunity Fund, which is a good large mid fund that he can look at, and he can also look at adding a PPFAS FlexiCap fund to the portfolio.
All right. Mr. Singh, since we did not have your previous portfolio details, we've just took the details now on the show live, and Kirtan has been kind enough to, hands-on information he's able to give you and sort you out on your financial portfolio. But if in case you're still not clear, I would request you to send us your question again. But so far, whatever you've heard, do you want to ask anything?
That's all. You have been so helpful, both of you. Thank you so much.
Thank you so much, sir. Thank you so much. All right, Kirtan, we move on to our next question. Vanraj Rathore, and he wants to invest 5,000 to 6,000 per month, and the purpose is retirement. We don't have him on the phone line with us, but then this is what he has given us. It's a question through email. Yeah.
Kavita, like you would know that I don't have any other details of when is he really retiring or what's his profile, etc. It's extremely difficult to make a comment. But let's say hypothetically, assuming that we still have to give him some recommendation, I would really suggest that he should split his 6,000 rupees into two different funds. One can be ICICI large and mid, and another can be the same fund that I recommended to Mr. Singh as well, which is Kotak India Opportunity. both of these funds will give him a decent exposure to large and mid. And let's say hypothetically, if he's got 10 years plus to invest for retirement and he has a slight risk appetite, he can also look at doing mid cap and small cap funds individually and independently. But let's say assuming given the information that we have, I think he can split 3,000 rupees each in an ICICI large cap and a Kotak India opportunity fund.
All right, so that is the answer for Vanraj's question. Also, one thing, it's very nice for people to, once we, the kind of questions we've been getting, Kirtan, a lot of awareness regarding having retirement as one of your very important financial goal is clearly an obvious trend in the questions also. But, the tricky part is, even though it should be the first financial goal that you need to set for yourself, a lot of people are not able to do it. What all actually goes into having a goal like retirement fixed at a very late stage in your life, maybe post 40s? What all do you miss?
See, actually, Kavita, what happens is when you are late in planning any goals, technically what ends up happening is that you will then have to start allocating a larger sum to reach the same goal. Let's say hypothetically, if I have to retire at 60 and my corpus requirement is 5 crore, if I start at 25, I might just have to invest 10,000 rupees towards that goal. But if I start at 40, I might have to invest 50,000 rupees to reach the same goal. So technically what starts happening is that the later you start investing for the same goal, your requirement to reach the same number is much higher than you would have otherwise had you started early. That's one. And second, also what happens is when you are in midlife and married, you probably suddenly would start having child's education as one goal, child's marriage as another goal. So what typically happens is that at that point in time, you suddenly have to start then give priority to whatever is the lowest hanging for you and allocate more money there. The challenge here is that after you've received your income and spent for your necessities and lifestyle, then it becomes very difficult to start allocating more money to more goals, right? And in mid 40s or early 40s, you typically start having these other goals that you have to meet, which were not there in the early 20s or even in the early 30s. So I think allocating money to different newer goals that have come up then starts becoming a challenge if your income has not increased. And then you have to start compromising on your goals because you don't have enough money to invest on it today.
All right. I think we can have a longer discussion on this, but then I have other viewer queries ready with me. Kirtan, I will be taking Dipesh Patel's question. This is again an email question, and he is 35 years old. The target corpus is 5 crores in 20 years. And he wants to understand, he wants to start an SIP to achieve the target. And he wants to understand the kind of allocation that should be going in the mutual funds. And he can add 10,000 and 15,000 more in SIP. Also, he wants to do a lump sum investment of 50,000 in small chunks. That's what he says. And yeah, that's Axis Long-Term Equity. He has DSP Tax Saver, Tata India Tax Saving Fund again, Invesco India Tax Saving, Nippon India Small Cap, SBI Small Cap. Just started, Mira Asset Emerging Blue Chip, Quant Mid Cap, Parag Parekh Flexi Cap. All right, so he's given the total corpus also that's there so far. Okay, so he wants to add more, 10 to 15,000, and also do a lump sum investment.
So Kavita, assuming that he's got 6 lakhs of investment already, plus the new investment that he wants to do, and if he needs a corpus of 5 crore in 20 years, assuming that the portfolio will be able to generate close to 12%, his actual SIP requirement is 50,000 a month, which is much higher than what he's currently doing, plus what he can add. So either he will have to start with a 50,000 rupee SIP immediately, or he can even do a step-up SIP. 50,000 is something that he cannot immediately do. So he can do the maximum that he can today, which is roughly 25 to 30,000 rupees, given the data that he shared with us. So he can start with 25, 30 today, and then try and increase the SIP every year. The faster he tries and does step up, the closer he'll be able to reach the goal. But mathematically, he has to do 50,000 rupee of SIP today to be able to reach the 5 crore goal, given the 6 lakh that he's accumulated. That's That's more on the goal that he had shared with us. On the portfolio that he shared, he's got 9-10 funds. Theoretically or even practically, you don't really require 10 funds in your portfolio. 3, 4, 5 funds largely should be able to help you diversify well enough. So I'm going to suggest him a couple of exits in his ELSS, because he's got 4 funds in ELSS, which I don't really think he requires. So he can actually exit his DSP, Axis and Invesco, and whatever money he accumulates, right, or the new money that he wants to invest, that actually needs to be spread across in the remaining funds in the portfolio. So if Diptesh tries and makes sure that the remaining funds in the portfolio, which are decent, is equally weighted in terms of investment, I think the portfolio is well balanced.
All right. Also, should he be looking at adding any new fund in his portfolio, or maybe that's really not needed?
I think not needed in his case. His other funds are decent funds, and only if he's able to exit these funds that I suggested and reinvest in the existing remaining funds, I think he should be able to do a good job.
Okay, I think, Kirtan, that will be all. Thank you so much for taking time out and helping our viewers with their financial portfolio queries today. Thank you. Time to sign off on The Money Show, but then I'm going to leave you with our WhatsApp number and email ID. 865-797-4571 is our WhatsApp number, and The Money Show at etnow.tv, where we keep waiting for your questions. Thank you so much for watching. Goodbye.